In present video, I am going to explain about third problem from company accounts topic. I am taking this question from advanced accountancy subject BCom second year semester 3 Pankaj publications book. Previous videos links are available in the description box. Let us see the question first. This is a question, third problem. A limited company was formed on January 1st, 2005 with an authorized capital of 3 lakh rupees divided into 1006% preference shares of 100 rupees each and 2000 equity shares of 100 rupees each. Here preference shares, when we buy, the dividend is fixed now. So company is going to pay 6% dividend per annum to preference shareholders. So that is the meaning of this 6%. On the same date, the company issued a prospectus asking for subscription to 500 preference shares and 1400 equity shares. Both classes of shares being payable 25 rupees per share on application, 40 rupees on allotment, and the remainder on a call. Means on equity share, on preference share, application money 25 rupees. Allotment money 40 rupees and the remaining money 100 rupees minus 25 plus 40 65 35 rupee is in the form of call. All shares were applied for and allotted and all cash due on allotment and call was received. Means there is no call scenario. Give the entries necessary to record the above in the books of the company and show how capital will appear in the balance sheet. This is a problem. Let us see the solution for this. Let us understand the question first. There is one limited company. Company wants to collect 3 lakh rupees from the public by selling shares. So company's share capital is 3 lakh rupees. In this, company wants to sell preference shares and equity shares, both. Preference shares, 1000 shares at the rate of 100 rupees each. Company wants to sell. So preference share capital is 1 lakh rupees. Equity shares, 2000 shares at the rate of 100 rupees each. Company wants to sell. So equity share amount is 2 lakh rupees. Total 3 lakh. Here one share price is 100 rupees now. This 100 rupees is known as face value of the share or par value of the share. And the company is authorized to collect 3 lakh rupees from public. So company's authorized capital is 3 lakh rupees. And in current year, company is not going to collect this total money. Out of this 1000 shares, in current year, company wants to issue only 500 shares. Similarly, equity shares, out of 2000, in current year, company issued only 1400 shares. So authorized capital, issued capital, both are not same. Issued capital is preference shares 500 at the rate of 100 rupees each, 50,000. Equity shares 1400 at the rate of 100 rupees each, 1,40,000. So total issued capital is 1,90,000. And the public applied for all these shares. Therefore, subscribed capital is also same. Subscribed capital is preference shares of 50,000, equity shares 1,40,000. Total 1,90,000. And in current year, company wants to collect these 100 rupees in 3 installments. Application money, allotment money and call money. Application money on one share 25 rupees. Allotment money 40 rupees. Remaining amount in the form of call company wants to collect. Total value is 100, one share price. In that, if you remove 25 and 40, 65, then remaining amount is 100 rupees minus 65 rupees, 35 rupees. So there are 3 installments. In previous problems, he used to give first call, second call, final call, like that. But here he didn't mention anything about calls. So our assumption is total money is collected through one call only. There is no first call, second call, final call. There is only one call. And in current year, company made all these calls. Therefore, called up capital is also same. 1,90,000. And in previous problems, he has given about calls in arrears. Some shareholders failed to pay some amounts. But in present problem, he is not giving any calls in arrears. Company received all these amounts on all shares. Therefore, there are no calls in arrears. Paid up capital is also same, 1,90,000 rupees. And what is asking in the question? For all these transactions, journal entries he is asking. And he is asking us to show the balance sheet. Let us see the journal entries first. First entry is for application. Regarding application, there are two entries. First one, for receiving application money from applicants, we should write. Second entry, that application account amount we should transfer to share capital. For that, we should write the second entry. So we are writing all these entries in company's books. Therefore, analyze all the transactions from company's point of view. And while writing journal entries, you should keep one point in mind. That is, debtor is an asset. Asset shows a debit balance. Creditor is a liability. Liability shows a credit balance. Debtor means a person who is liable to the firm. He has to pay money to us. Creditor means a person to whom firm is liable. We have to pay money to him. First, what happened? Application money is received from the applicants. So, preference shares, 500 shares are applied by the public now. On each share, application money is 25 rupees. 500 into 25, 12,500 company received from preference shareholders. Similarly, company issued 1,400 equity shares and all these shares are subscribed by the public. Means public paid application money on total 1,400 shares. And in question he is giving that on equity share, on preference share, application money is same, 25 rupees. So on equity share, 1,400 into 25 rupees on per share, total 35,000 rupee is coming towards application money. These two amounts, our assumption is directly applicants are depositing in company's bank account. So in bank, total 47,500, total of these two amounts is deposited. Now what is the journal entry for this? There are two accounts here, bank account, applicant's accounts. Both are personal accounts. Personal account rule, debit the receiver, credit the giver. So bank is receiving money now, debit the receiver is applicable. Therefore, bank account we have to debit. In first entry, bank account we should debit. Bank account data, two amounts are coming now. Preference share application money is coming. Equity share application money is coming. So actually speaking, here we should credit applicants' names. But applicants are so many, their names individually we cannot write. So instead of writing applicants' names, we are writing preference share application account, equity share application account. So these two accounts are personal accounts. Because instead of writing applicants' names, we are writing these two words. We can apply personal account rule, debit the receiver, credit the giver. But I prefer that. So here, from applicants, we are receiving money. In future, we have to return that amounts to applicants. No? So for these amounts, applicants are creditors. Because in future, company has to return that money. Creditor is a liability. Liability shows a credit balance. Therefore, these two accounts, preference share application account, equity share application account, we have to credit. 2. Preference share application account. 2. Equity share application account. Amounts. Preference share application amount 12,500. Equity share application amount 35,000. For bank, write the total 47,500. This is the first entry. This is the journal format. Journal, serial number, particulars, debit, credit. LF number column we can ignore. First entry is bank account debtor to preference share application account to equity share application account. Narration, what happened here, see. On 500 preference shares at the rate of 25 rupees each, 12,500 application money came. On 1400 equity shares at the rate of 25 rupees each, 35,000 application money came. For that we are writing this entry now. Mention that in the narration. Being application money on 500 preference shares and 1400 equity shares at 25 rupees per share received. Now come to second entry. Second entry is these two accounts we have to close by transferring their balances to share capital account. Because application money, allotment money, call money, finally we have to show in the form of share capital only. So share capital is also a liability because from applicants we are receiving that capital amount. In future company has to return that money to applicants. Share capital is a liability. Liability shows a credit balance now. Therefore share capital account we have to credit. Two capitals are there, preference share capital, equity share capital, both we have to credit. To preference share capital account, to equity share capital account. These two application amounts we are transferring to capital accounts. After transferring, these two application accounts will get closed. How to close them? By crediting we have created in first entry. If you want to close those accounts, you have to debit. Therefore, preference share application account we should debit. Equity share application account also we have to debit. Amounts. Preference share application amount 12,500 we are transferring to preference share capital account. Similarly, equity share application amount 35,000 we are transferring to equity share capital account. So this is second entry. This is the second entry. Preference share application account debtor, equity share application account debtor, to preference share capital account, to equity share capital account. So what we are doing here, this amount, preference share application amount, we are transferring to preference share capital account. This amount 35,000 equity share application amount, we are transferring to equity share capital account. For that we are writing this entry now. In narration mention that being preference share, comma, equity share application amounts transferred to preference share capital account and equity share capital account. Now come to third entry. Third entry is for allotment. In third entry, transfer entry we should write. Transferring allotment money to capital account. In fourth entry, receiving the allotment money. For that we should write one entry. See, in case of application, first we wrote cash received entry, then we wrote transfer entry. But in case of allotment, in case of call, first we will write transfer entry, then we will write cash received entry. Because now we know how much money we should receive. So directly transfer entry we can write. To transfer application money to capital account, share capitals are created now. To transfer allotment amounts to capital account also, share capitals are to be credited. Because capital is a liability, liability shows a credit balance. We should credit preference share capital account and equity share capital account. Amounts. Applicant subscribed for 500 shares now. On one share, on one preference share and on one equity share, company should receive 40 rupees allotment money. So 500 into 40 rupees, 20,000 should come in the form of allotment on preference shares. 1400 shares into 40 rupees each, 56,000 should come in the form of allotment money on equity shares. These two amounts only we should transfer to capital accounts now. Therefore, preference share capital account amount is 20,000 rupees. Equity share capital amount is 56,000 rupees. These two amounts company has to receive from applicants. So for these two amounts, applicants are debtors because they have to pay these amounts to the company. Debtor is an asset. Asset shows a debit balance. Therefore, we have to debit applicants' accounts. But applicants are many. Their names we cannot write. So instead of writing their names, we write preference share allotment account, equity share allotment account. Like equity share application account, preference share application account, Equity share allotment account, preference share allotment account. These two accounts are also personal accounts because in the place of applicants' names, we are writing these accounts. Preference share allotment account data, equity share allotment account data, two capitals accounts. Preference share allotment 20,000 rupees. Equity share allotment account amount is 56,000 rupees. So this is the third entry. This is the third entry. Preference share allotment account data, equity share allotment account data, 2 preference share capital account, 2 equity share capital account. So for what we are writing this entry? Preference share allotment amount 20,000. We want to transfer to preference share capital account. Similarly, equity share allotment amount 56,000. We want to transfer to equity share capital account. For that, we are writing this entry now. Mention that in the narration. Being preference share comma equity share allotment amounts transferred to preference share capital account and equity share capital account. Next, come to received entry. Allotment money received entry. These two amounts we received now. There is no call scenario here. So from applicants, company is receiving these two amounts. Here also our assumption is applicants are directly depositing these amounts in bank account. So there are two accounts, bank account, applicants accounts. Bank account is a personal account. Personal account rule, debit the receiver, credit the giver. Bank is a receiver now, therefore we have to debit bank account. Bank account data 2. In third entry, we have debited allotment accounts. We are writing here that applicants are debtors. From them we have to receive these amounts. When we received these amounts, that debtor accounts we have to close now. How we open these accounts? By debiting. How to close them? By crediting. Therefore, we should credit preference share allotment account and equity share allotment account. Amounts, preference share allotment amount we created with 20,000, so we have to close with the same amount. Equity share we have created with 56,000, therefore we should close with the same amount. Now for bank, total of these two amounts 76,000. So for allotment also two entries, transfer entry, received entry. See, this is the fourth entry. Bank account data, 2 preference share allotment account, 2 equity share allotment account. Narration, for what we are writing this entry? Preference share allotment amount 20,000 we received. Equity share allotment amount 56,000 we received. Mention that in the narration. Being allotment money on 500 preference shares and 1400 equity shares at 40 rupees per share received. Now come to call related entries. As I explained earlier, in present problem there is no first call, there is no second call, there is no final call. Only one call is there. And how much money company should receive on that? Face value of one share is 100 rupees. In case of preference share, in case of equity share, same amounts. Application money per share 25. Allotment money per share 40 rupees. 25 plus 40, 65. So 100 rupees minus 65 rupees. Remaining amount 35 rupee is call money on one share. In question, directly call money he is not giving. That is why we have to calculate in this form. So preference shares on 500 shares at the rate of 35 rupees each, 17,500 should come. Equity shares on 1400 shares at the rate of 35 rupees each, 49,000 should come. So like allotment, in case of call related entries also, first we write transfer entry, then we write received entry. What is the transfer entry? Like third entry. To transfer allotment accounts to capital accounts. This is the entry now. Similarly, to transfer call money to capital accounts, same rule we follow here. Instead of preference share allotment, we debit preference share call account data. Instead of equity share allotment account, we debit equity share call account. 2. Same. preference share capital, equity share capital. To preference share capital account, to equity share capital account. Preference share call money 17,500. We should transfer to preference share capital account. Equity share call money 49,000 rupees. We should transfer to equity share capital account. Why we are crediting capital accounts here? Same explanation. So call money we are transferring to capital account. Capital is a liability. Liability shows a credit balance. That is why capital accounts are created. Why preference share call, equity share call accounts are debited? These two amounts from applicants we should receive. So to the company, applicants are debtors for these two amounts. They have to pay. Debtor is an asset. Asset shows a debit balance. Instead of writing applicants' names, we are writing these two words. Therefore, preference share call account, equity share call account. These two accounts are also personal accounts because instead of writing applicants' names, we are writing these accounts. This is the fifth entry. Preference share call account debtor, equity share call account debtor, to preference share capital account, to equity share capital account. Narration. Why we are writing this entry? Preference share call amount 17,500 we want to transfer to preference share capital account. Equity share call amount 49,000 rupees we want to transfer to equity share capital account. For that we are writing this entry now. Mention that in the narration. Being preference share, comma, equity share call amounts transferred to preference share capital account and equity share capital account. Now come to sixth entry, last entry. Sixth entry is for receiving call money. There are no call scenarios now. Total amounts company received from applicants. So our assumption is applicants are depositing these amounts in company's bank account. So bank account is a personal account and a bank is a receiver here now. So personal account rule, debit the receiver, credit the giver. First line is applicable here. Bank account we should debit. Bank account debtor. Which accounts we should credit? See this fifth entry. Here we wrote that applicants are debtors to us. They have to pay amounts to us. When they paid that amounts, now these debtors accounts we have to cancel now. In fifth entry, by debiting we have created debtors accounts. If you want to cancel them, you have to credit. Therefore, we should credit preference share call account and equity share call account. We have created them with 17,500 and 49,000. Therefore, we have to close them with the same amounts. 17,500 and 49,000. Total 66,500 is coming in bank account now. Debit that amount. Remember, regarding share call also there are two entries. Transfer entry, money received entry. See, this is sixth entry. Bank account debtor to preference share call account to equity share call account. For what we are writing this entry? Preference share call money 17,500 we received. Equity share call money 49,000 we received. For that we are writing this entry now. Mention that in the narration. Being call money on 500 preference shares, 1400 equity shares at 35 rupees per share. How 35 came? 100 minus 25 plus 40, 65. 100 minus 65, 35. This is call money. On equity share, on preference share, call money is same, 35 rupees per share. Per share received. Take a screenshot of journal. Next page. Journal is completed. Next, let us see how to prepare balance sheet. See, this is company's balance sheet. Heading, balance sheet of limited company as at dash. Liabilities amount, assets amount. Under liabilities, we have to show share capital details. Heading, share capital. First, authorized capital. Company is allowed to issue 1,000 preference shares at the rate of 100 rupees each, 2,000 equity shares at the rate of 100 rupees each. So preference share authorized capital is 1 lakh, equity share authorized capital is 2 lakh. Total authorized capital 3 lakh rupees. But for totaling purpose, we should not consider authorized capital amount. That is why for 3 lakh rupees, draw 2 lines. Next, issued capital. Out of 1000 shares, in current year, company issued 500 preference shares. Similarly, out of 2000 equity shares, in current year, company issued 1400 equity shares. So authorized capital, issued capital, both are not same. 500 preference shares at the rate of 100 rupees each, 50,000. 1400 equity shares at the rate of 100 rupees each, 1,40,000. Total issued capital is 1,90,000. Next is subscribed capital. See, issued capital, subscribed capital, both are same only. Public applied for 500 preference shares and 1400 equity shares. Therefore, both are same. But separately we have to show now. That is why separately I am showing subscribed capital. 500 preference shares of 100 rupees each, 50,000. 1400 equity shares of 100 rupees each, 1,40,000. Total subscribed capital is 1,90,000. Now finally come to called up and paid up capital. So authorized capital, issued capital, subscribed capital separately we have to show. But called up and paid up capitals combinedly we have to show. Called up capital. In current year, company made application, company made allotment, and company made call also. Means all these three amounts in current year only company received. Therefore, called up capital is also same. Subscribed capital, called up capital same. 500 preference shares at the rate of 100 rupees each, 50,000. 1400 equity shares at the rate of 100 rupees each, 1,40,000. Total called up capital is 1,90,000. And paid up capital. In previous problems, he used to give calls in arrears. But in present problem, he is giving that all applicants paid application money, allotment money, and call money on all shares. Therefore, there are no calls in arrears. Means paid up capital is also same. Called up capital, paid up capital, both are same. For paid up capital also same calculation is applicable. Therefore, preference share paid up capital 50,000, equity share paid up capital 1,40,000, total 1,90,000. Paid up capital is 1,90,000. So liability side completed. This paid up capital we are going to consider for calculating the total of liability side. So we should not consider even subscribed capital, issued capital also. That is why for issued capital amounts, subscribed capital amounts, we drew 2 lines. Come to asset side. Finally, from applicant's company received 1,90,000 rupees now. Our assumption is this money is deposited in company's bank account. Therefore, under asset side, as cash at bank, this amount appears. So cash at bank 1,90,000. Two side total same. Liability side 1,90,000, asset side also 1,90,000. So balance sheet is completed. Take a screenshot of balance sheet. So this is the end of present video. Hope this video is helpful to you. Thank you.